All right, welcome back to another podcast. I'm Josh Kozis and this is Michael Harvey.
Hello everyone.
Thought we'd piggyback off the last episode where we talked about the recent move that the RBA made to lower interest rates, how that has a flow-on effect with different types of loans. So we thought it'd be a good opportunity to actually educate people on the different types of loans, some of the features, some of the pitfalls and strategies you can use to get on top of things.
Yep, good idea, Josh.
I think it's important to quickly just remind everyone that unfortunately we don't know who's on the other side of the phone, so everything's generally in information that we're providing today. It's really just to help you ask better questions and certainly, if you're unsure about your situation, just to seek professional financial advice. What we might start off with is, I guess in the last RBA video that we did, they lowered interest rates by 0.25%.
Yep.
Really good for those who are wealth accumulating and have home loans or investment loans. But for the retirees, not so much.
They're taking a little bit of a lower income, potentially. So.
Yep, and if the RBA continues to lower rates, well, that's likely to continue as well.
Yeah.
So, thought today we might focus on the, wealth accumulator side of the fence with home loans.
So wealth accumulators, what are you talking about?
Yeah, so I guess wealth accumulator would be we're still accruing assets, we're not yet spending them down to fund retirement.
Okay. Yep.
Whereas retirees, you've kind of built a pot of money and you're trying to get a return that then pays for groceries.
Yep.
So sticking on that side, so I consider myself a wealth accumulator. So I've got a mortgage on my home, got investment property as well with a debt associated.
Yep.
Part of what we could touch on today is, I guess from the investment side of things, tax deductibility. Some people hear the terminology of those barbecue chats around negative gearing and those buzzwords, so trying to understand and unpack a little bit more about what that means.
Yeah.
But the primary focus for me today is really talking around the primary residence, so your home that you're living in, and how to structure debt effectively. We all want to pay down debt as quick as we can and don't want to give too much away, so might get stuck into that.
Yeah, so I suppose the home loan, what are some of the terms that people might come across, Josh, when they go through a home loan process?
Yep, so the first one I'd say is home loans are generally split into two camps. You've got your variable rate loans and your fixed rate loans. That's probably what most people would be familiar with, that terminology.
Yep.
I guess if we talk about the pros and cons of each, you've got variable loans allow a bit more flexibility in loan repayments. Also if rates, so when the RBA recently dropped the interest rate, that then has a flow-on effect when the bank passes it on that you benefit from. However, someone in a fixed rate arrangement, they say, hey, for a period of say 1 or 2 years, no matter what happens in the economy, my interest rate's not going to change.
So it gives some people peace of mind that they've got a definite repayment amount over that period.
Yeah, and we did have, people might have heard as well that when COVID had happened, interest rates hit historic lows. Some people locked in for 3 to 5 years and they're coming off those fixed rates now.
Yep.
Oftentimes switching from a low 2% rate up to a 6+% rate, which can be quite a strain on young families and people who don't have cash flow under control. So that's where seeing the relief from the RBA, dropping things 0.25%, people are starting to take a little bit more air in. They were feeling a little bit compressed.
And you can see I've seen people do the split as well. They might have say half and half between a fixed and a variable component on their mortgage, and some banks offer that, which is quite a nice hybrid model that you might lock half of it away into a fixed arrangement and still have half the benefit if interest rates move. So
and that can be a really good strategy, because what we don't want to be doing is effectively gambling on whether or not we think the economy will do well or it won't, in the same way that you don't know if a share is going to go up or down and you don't know whether to buy more or sell. I'd say splitting loans can be effective. A worthy thing to point out would be variable loans often have more feature flexibility. So think about things like your offset accounts, your redraw accounts. Oftentimes your fixed rate loans lose that depending on the bank, or you have to pay additional fees to get those features put on.
Yeah, maybe just you touched upon offsets, so I'll just re-emphasise offsets. I love offsets, and so a couple of things to watch there is I have heard sometimes some banks may charge a premium if there's an offset available. So just make sure that even though it's a great feature, that you're not paying more for that. And the beauty of offsets is effectively whatever spare cash you got lying around, you're getting paid your mortgage rate on those funds. So it sits in a separate account, but effectively the interest calculation typically done on a daily basis is on the net balance between. So if you've got a mortgage of $250,000 and $10,000 in your offset account, you're getting charged on the net difference of $240,000.
Yeah.
So it's just a great way of doing it. If you're saving for a holiday or if you're saving something else, then it's just a great savings account. The other one, just putting my accountant tax hat on for a minute, then say if your current home has an offset account, the interest on that, if it's just your primary residence, is not tax deductible. But in 5 years' time, you decide, I want to hold on to that home, or we want to upgrade or move somewhere else, and the new home becomes your primary residence. The beauty of an offset account is that offset can then follow to the new house, and then your mortgage still sits there as tax deductible debt or interest on that mortgage. Whereas if you paid it down, you can't redraw or top up your home loan balance purely for the sake of this becomes your investment property, not your primary residence. So it's probably just that's from a tax perspective, offsets work really well certainly for those people that maybe have an idea in mind that over a 5 or 10 year period it could be possible that house is not my forever home. It's like a starting point, and they like the area, like the house, but it's become an investment property maybe one day.
Yeah, that's a great point. I actually had a client about 9 months ago in a similar situation. So going through now on a high income earning job, and the goal was always just told by the parents, pay off debt. And so that's what they did. And they got down to about $50,000 owing on their little 2-bedroom starter home. But then they went and had 2 kids and said, we need to move and get a bigger house. So why don't we turn the property room, which we love, into an investment and buy this, $1 million plus home. But now they've got, say $800,000 worth of debt on their new primary residence. That's not tax deductible. Meanwhile, no debt associated with the investment property. And for a high income earner, you really want that tax deduction. And so just not understanding something, as simple as an offset account that could have just solved that problem, potentially led to $1,000 of tax savings every year.
That's a good example of that one, Josh.
It's a powerful tool. And it's a good point you made around, if you've got $250,000 worth of debt, $10,000 in an offset account, you're only going to be charged interest on the $240,000, which actually means that $10,000 you've got in the offset account, you're benefiting by that 6.5% interest rate.
You won't get better interest rate anywhere else. So.
Look, and that's it's good. But if you're saving $650 in, I guess, interest, but then you're paying $400 a year in the fee to have the offset account, you're really only getting the net benefit of that $200, which is
that's right.
Fees can really drag on some of the benefits. And certainly for those, some banks only offer, say, a single offset account, so you have a major savings that you've got. But if you're somebody who has a holiday account, a hobby account, your savings account, some banks offer offset across all of them. Aggregates all of your credits, less your negatives, and charges you from there. So that's kind of offsets, I guess, as a bit of a summary. We really could go in lots of directions. There's a lot of anecdotes for different clients on how they've been used, but another one would be redraw. I think if you were to break it down further, you've got variable, you've got fixed, and then within that you've got offset versus redraw. So if we talk about the benefits of or the differences between them.
So redraw is, say if you've got a $250,000 loan, the $10,000 rather than in an offset account, you just pay it down off your mortgage. So your new mortgage amount is $240,000. What often the banks would allow you to redraw that back out upon certain conditions. So if you need it for a rainy day, then you can pull it back out. So the net effect is about the same. So that the only downside is probably in my head just from a tax perspective. That scenario you gave when your circumstances change, you can't redraw that amount purely to buy a private home. That's probably just a tax office interpretation and ruling on that one. So,
but really important. There's another anecdote I've got. This has happened in the last 6 months with a client because offset accounts and redraws, they're both allowing you to repay debt faster and to save loan interest, which is great. They're both retaining a bit of liquidity if you need to get those funds back for personal use. The key comes down to the tax deductibility because the ATO says, look, unless funds that you borrow are used for investment purposes, they're not tax deductible. So all of a sudden you redraw on an investment property to go buy a brand new car that you've always wanted. Just because you've borrowed more against an investment asset doesn't mean it's deductible for the purpose of the money. So again, offsets versus redraw. So it's a great point.
What about some of the other terminology people might come across then, Josh? Like say loan to value ratios, that's sort of LVRs, sometimes you see that.
Classic financial industry, we're always throwing around acronyms. We love acronyms. So loan to value ratio is really, if I was to do it with a calculator, it'd be the balance of my loan divided by the value of my home times 100 to express it as a percentage. If that percentage is 80% or higher, typically you'll get hit with lender's mortgage insurance if you're refinancing, or
So
initially...
Explain that one to me a bit more.
The lender's mortgage
LMI,
insurance?
yeah.
Yep. So if a bank says you're subject to LMI or lender's mortgage insurance, what the bank's doing is saying, because you're borrowing much more of this asset, we're seeing you as slightly higher risk, or at least there's a risk that you may not make your repayment. So we're going to take out an insurance policy against that says if you default on your mortgage, we'll still get our money, but we're going to charge you the premium for it. You can foot the bill, and that then gets added to your loan. So for someone buying a $600,000 house, if you've only got $480,000 that you can borrow because of your deposit, they're going to add that lender's mortgage insurance on top to your borrowed amount, and you'll pay interest on it as well.
Yep. So try to avoid that if you can. I mean, some people, it's unavoidable.
Mm-hmm.
Like my first home, we did. We paid it, but it's sort of grates with you.
It does sting, and you can get it refunded in some cases. So as an example, in a rare case that your house goes up in value so much that if you refinanced within 12 months, your LVR or loan to value ratio gets back to a healthy level, then potentially some of that premium can get refunded, but it's very unlikely. Some of the ways you can avoid it would be have a larger deposit, which is not always possible. Buy a cheaper home, not always ideal depending on your family circumstances, or there's also the option for guarantor as well.
Or the bank of mum and dad, that's another
Bank
option.
of mum and dad, for some their parents are quite happy to do that. So
and that's an honest one. Like with our kids, we've got 3 adult kids, and we provided a short-term funding arrangement for our kids, just because it was like, for their example, maybe $4 or $5 grand LMI insurance, and I go, well, it's just a waste of money for the sake of us lending an additional amount that brings their loan to value ratio around the 80% mark, and therefore didn't need it. So don't forget the bank of mum and dad.
It's a good one.
So just to sort of re-emphasise the loan to value ratio, there's a couple of aspects there. So if it's a $500,000 house, you borrowed $400,000, your loan to value ratio is 80% in that example. So what, as a strategy going forward, this is not probably a debt one, this is probably more of an investment strategy, is as that, so you're looking to pay your interest and principal interest down off your $400,000 debt, but at the same time, rules of thumb is that the capital appreciation in that $500,000 house and might be worth $600,000 in 5 years' time, and you pay the debt down to $300,000, and you've got a loan to value ratio of 50%. For some people, that's what their goal is, and then for others, it might be you've now got an equity. Some people call about equity. I've got more equity in my own home, and some people then like to leverage that if property's their thing, to say, well, I can use that equity to then go and buy an investment property or upgrade. In your example, upgrade to their dream home, and then have that sitting as their investment property. So that's where you might hear the barbecue conversation with someone. I've leveraged my equity in my home or something like that. Where's the effect? And that's effectively how you sort of basically, it's a dual strategy: bring your debt down, as well as the market forces increasing the value of your property. And then sometimes people go, if I add another room or put a deck on the place or something like that, that's sort of another way of adding value. And even though you haven't sold it, it's the bank would revalue it based on the market conditions, especially if you went from it's a big significant change. You went from a 2-bedroom to a 3-bedroom. That's a substantial change in the profile of that place. So.
Yeah, absolutely. And that's, as you mentioned, so equity being, the bank will consider that an asset that they can use to use as security for you to borrow more money.
That's right. I think the point was you don't have to then sell it to access that equity. It's available if you want to then leverage that and use that equity as a deposit, inverted commas, for your next home or for an investment property.
Yeah, and it's important to note that it's really for that purpose, as opposed to going, sometimes you can pull money out to do a renovation or to fund a caravan or something, but not usually. It's usually home improvements or investment.
Yeah, most banks will look at the purpose behind it. So renos get up, but then if you're just looking to more of a lifestyle asset, it's a bit more problematic.
Yeah, absolutely.
So we've covered some of the terminology, maybe some strategies to pay down debt faster. We've talked about the compound, or we haven't talked about the compounding effect of interest. Maybe
previous video, I think one of our first ones, we talked about, I guess, just budgeting and getting your finances under control. And one of those components was paying back debt as fast as you can, when you can. So I guess we can talk about the snowball effect. Really, that's just taking your highest interest loan that you've got. Maybe it's a credit card that you've got sitting there that some people I know use them for the points and they've got that behavioural side locked down. But if you found that, someone who's had a credit card for a long time, there's always a balance owing where you are paying the interest on it. You're not able to clear it every month. You're probably paying, 15 to 20% on the credit card, depending on the bank.
Yeah, and it's a nasty one if you don't meet the minimum. If you don't pay the balance off. So a couple of points on the credit card, because people can get caught in that. There's a minimum amount to be repaid, which some people misinterpret that as being the amount you have to pay to not charge interest. But that's all that is just a minimum amount just to tick it along, but then you'll be charged interest. It's a very high interest rate, as you said, Joffy. And then the other one is that often the calculation goes back to the original purchase date of that transaction that wasn't paid off in full on the due date. So you get slugged with a higher interest rate. So for me, I make sure that I've got it on direct debit, so I actually never have an accidental non-payment of the full amount that's due. In my case, 15 days after the end of each month. Over the journey of my life, I've been caught a few times, and it's just a really nasty sting.
Yeah, it does happen, and it's important noting that everyone has different. Well, not everyone. Certain banks have different repayment dates before they'll charge you interest, so it's important to get across what those are, because it can change. If you've got multiple banks with different credit cards, or your partners with a different bank, important that you don't just assume that you've got the same time period to pay it back, because although you get the benefits of saying, meanwhile I've got money sitting in my offset account that's saving me home loan interest while I'm using my credit cards, I'm also getting the points. You only have to come unstuck maybe 2 or 3 times in that year, and you've offset the full benefit of what you're trying to achieve. So discipline definitely is important there, and just understanding the products that you're involved with. Yeah.
And I think you touched upon credit card debt. So if people have got themselves into a scenario where they are unable to repay the full amount each month, and therefore it's compounding at a high interest rate, what some of the options that people might want to consider to remove that credit card debt or get on top of it?
Look, I suppose if you had savings sitting there, I'd be considering, or in an offset account, straight away I'd go, well look, we're offsetting 6.5%. Do we instead pay back the credit card that's charging us 17? That would be a pretty quick win.
Definite win there. Yep.
I guess some other ways would just be to switch your spending around so that you're not adding more to the credit card. You're not increasing that balance over time, so that as you make repayments, you actually are paying down the principal on that. There's other options in the market that we probably won't go into too much detail on today on how you can potentially consolidate loans. So as an example, if you were going through a refinance on your mortgage because you wanted to access equity or borrow money for renovations, it might be a good opportunity to say, can we borrow the extra $5,000 under this refinance to then clear that credit card?
Yeah.
That could be an option as well.
Yeah, certainly look at because going back to that equity discussion, if the banks reconsider that the market has moved and you've got extra equity just through market forces of your value of your property, then if you can work your way through what the purpose of it, you might be able to free up some cash from the equity to pay off your credit card, which is your highest cost at the moment. So
which can definitely be a good option. I mean, I always get a bit cautious around the behavioural side of things, because I think, if someone's gotten into a debt that they can't repay already, do we want to be borrowing more debt to pay that debt? I'd much prefer to deal with the behavioural side, but certainly if we're someone who's getting on track with the budget, we know what income's coming through and it's being allocated correctly, and we're now at a point where we're really prioritising paying debt instead of chuffing off to Fiji or, stopping in for those ad hoc expenses, it could be something worth looking at.
And certainly some people, they'll say, I've cut off my credit card, but I've got a historical credit card debt, so they're trying to get on top of their finances. So certainly in that scenario, you're comparing like a 15 and 20% interest rate compounding on your credit card debt versus 6 or 7% if you've got a home mortgage. So that makes sense if as you mentioned, if it's, or if all you're doing is just digging yourself out of a hole and the hole will create again, that's not really going to work. But if you've got yourself on a different platform, different strategy, different mindset, then it's a way of getting yourself out of the bind that you might have found yourself in.
Yeah, and we talked about snowballing, and that's you want snowballing to pay down debt, not snowballing to increase the credit card balance. So, yeah, in terms of a tool or a product, certainly you want to know exactly your purpose for using a credit card and be quite disciplined with it, because we do see people come unstuck, unfortunately, or we have new clients coming in who go, hey, I need help getting out of some issues.
Yeah, all right.
Very good. So that's the main one.
I think we've covered off the fair content today, Joshy.
Yeah, it has. I mean, we could really keep going for another half an hour at least.
Yep.
I think. We didn't even get into extra repayments on home loans, and I guess talking about gearing. There's a lot we can cover, so we might
save it for another day.
Yeah, might do a part 2.
Yep.
Excellent. Well, thanks for joining us. We'll see you again next time.
Thanks, guys.